The White House has retracted the nomination of E.J. Antony to lead the Bureau of Labor Statistics, BLS, following the dismissal of former BLS Commissioner Erica McIntarfer. This decision comes after significant downward revisions to U.S. jobs reports, highlighting a slowdown in hiring and raising concerns about the reliability of employment data. The BLS is a critical federal agency responsible for producing essential economic data, such as employment figures, which are vital for economic policymaking and market confidence. The withdrawal of Antony's nomination indicates potential internal disagreements or strategic recalibrations within the Trump administration regarding the management and presentation of economic data. Accurate labor market data is crucial for shaping economic policy and influencing financial markets, as it provides insights into the health of the labor market. In a separate development, Pfizer has agreed with the Trump administration to lower prescription drug costs for Medicaid by offering the most favored nation pricing, matching the lowest prices offered in other developed countries. This move aligns with the administration's broader efforts to reduce healthcare expenses and could set a precedent for other pharmaceutical companies to follow, potentially alleviating cost burdens on the healthcare system and patients. Additionally, the U.S. Equal Employment Opportunity Commission has decided to cease investigations into disparate impact liability cases, signaling a significant shift in the enforcement of workplace discrimination laws. This change, prompted by an executive order from President Trump, could weaken protections against workplace discrimination, affecting market sentiment and corporate diversity strategies. Critics argue that the decision may undermine efforts to combat indirect discrimination, as the legal standard addresses policies that, while appearing neutral, disproportionately affect certain groups.
In the second quarter of 2025, the cost of home remodeling and repair projects has risen beyond the general inflation rate, as highlighted by Verisk's Repair and Remodeling Index. This index, which tracks over 10,000 home improvement products, reported a 3.4% year-over-year increase, outpacing the 2.7% rise in the Consumer Price Index. The primary driver of this cost surge is escalating labor expenses, particularly for labor-intensive projects such as tile flooring and bathroom remodeling. Despite a slower rate of increase compared to the first quarter, these costs remain significantly higher than in previous years. Contributing to the cost pressures are tariffs imposed by the Trump administration on imported goods, including a new 50% import tax on kitchen cabinets and bathroom vanities. These tariffs are expected to further inflate remodeling expenses, potentially adding $280 to project costs. The economic backdrop includes ongoing challenges in the housing market, with sales of previously occupied homes at their lowest in nearly 3 decades, exacerbated by rising mortgage rates since 2022. Homeowner spending on maintenance and improvements rose by 1.8% to $510 billion in the second quarter, according to Harvard University's Joint Center for Housing Studies. However, this growth is projected to decelerate in 2026 due to the sluggish housing market and reduced new home construction. Companies in the home improvement sector, such as Home Depot and Lowe's, may need to adjust their pricing strategies or profit margins in response to these trends, while investors should closely monitor the potential impact on stock performance and market sentiment.
Poundland, the UK-based discount retailer, is implementing a significant change in its pricing strategy to attract customers after narrowly avoiding administration earlier this year. The company is reverting to a more simplified pricing structure, with 60% of its stock now priced at £1 and the remainder at £2 and £3. This move comes after a previous shift away from the £1 price point, which saw the introduction of higher price tiers. The strategy was trialed in 17 stores in the Midlands, where the company observed positive customer response to reduced prices and a more focused product range. The restructuring is part of a broader turnaround plan, which includes a £60 million funding injection and a store closure program aimed at consolidating its retail footprint. Despite already closing 57 stores, Poundland plans to reduce its total store count from 800 to approximately 650 to 700. Although 11 stores initially slated for closure will remain open. Managing Director Barry Williams emphasized the company's commitment to delivering value and simplifying its offerings to meet customer expectations. This strategic pivot is crucial for Poundland as it seeks to stabilize its financial position and compete effectively in the discount retail market.
Nvidia's stock has surged 35% this year, continuing its impressive trajectory with a 1,293% growth over the past 5 years. The company's recent performance has been bolstered by a strong financial showing, with a 56% year-on-year revenue increase in its latest quarter, resulting in a net income of $26 billion, up 59% from the previous year. This robust growth has pushed Nvidia's market capitalization to an impressive $4.4 trillion, equating to about 52 times its earnings, which some analysts view as overvalued. However, the market remains optimistic about Nvidia's future prospects, particularly in the burgeoning AI sector, which could drive further demand for its chips. The potential for continued growth in Nvidia's stock price hinges on the sustained expansion of the AI market. The company is well positioned with its proprietary chip designs and extensive client base, which could capitalize on an expanding end market. However, there is a risk that the current AI investment boom may not persist, leading to challenges in justifying the current stock valuation. Investors are advised to weigh these factors carefully, considering the inherent risks and potential rewards associated with Nvidia's stock, particularly in the context of their individual financial circumstances and investment strategies.
Hibiscus EP Brunei, BV, a subsidiary of the Malaysia-listed Hibiscus Petroleum Berhad, has partnered with GEP Software to enhance its procurement processes through digitization. The initiative aims to optimize the source-to-contract (S2C) process, which includes sourcing, supplier management, and contract management, using an AI-powered platform. This strategic move will streamline Hibiscus's upstream procurement operations, leveraging GEP's established sourcing module, already utilized by its parent company. The deployment is expected to integrate smoothly with existing ERP systems, with a go-live target set for late September 2025. The adoption of GEP software, recognized as a leader in the 2025 Magic Quadrant for Source-to-Pay (S2P) suites, signifies a major step for Hibiscus Petroleum in enhancing operational efficiency and agility. GEP software, powered by GEP Quantum, offers advanced AI-driven capabilities that promise improved visibility and actionable intelligence across procurement and supply chain functions. This strategic enhancement is anticipated to drive significant return on investment (ROI) by reducing infrastructure and support costs, thus reinforcing Hibiscus Petroleum's competitive edge in the global energy market.
As the U.S. government faces the possibility of a shutdown, federal workers and active-duty military personnel stand to be the most affected, with their paychecks potentially halted. The shutdown, which would commence if Congress fails to pass a new funding bill by October 1, 2025, could see non-essential government operations suspended, impacting a range of services. Essential services like air traffic control and the U.S. Postal Service will continue, albeit with possible delays due to reduced staffing levels. Federal employees and military members will miss their first full paycheck by mid-October, although they are expected to receive back pay once the shutdown concludes. The potential shutdown underscores the ongoing political impasse, with Republicans requiring support from at least 7 Senate Democrats to approve a spending package. The economic repercussions could extend beyond federal employees, affecting programs like the Supplemental Nutrition Assistance Program, SNAP, and the Supplemental Nutrition Program for Women, Infants, and Children, WIC, which may face delays or funding shortages. Additionally, the Federal Emergency Management Agency, FEMA, could experience funding constraints, potentially delaying disaster relief efforts. This situation highlights the broader economic and social impacts of a government shutdown, emphasizing the need for timely legislative action to mitigate disruptions.
During the second quarter, both Sterling Investment Advisors Limited and Presper Financial Architects LLC made significant investments in the Vanguard S&P 500 ETF, NYSEARCA, VU, reflecting a broader trend among institutional investors to increase their holdings in this prominent exchange-traded fund. Sterling Investment Advisors increased its stake by 6.5%, adding 63 shares to hold a total of 1,028 shares, valued at approximately $584,000. Meanwhile, Presper Financial Architects acquired a new position by purchasing 3,635 shares valued at about $2,065,000. making VU the 10th largest holding in their portfolio, comprising 1.5% of their total investments. The Vanguard S&P 500 ETF is designed to track the performance of the S&P 500 index, which represents large-cap U.S. stocks, and is favored by investors for its diversified exposure and low expense ratio. The ETF is currently trading near its 12-month high, with share prices ranging from $610.13 to $615.26, and has a market capitalization of $733.09 billion. It maintains a price-to-earnings ratio of 24.97 and a beta of 1.00, indicating its price movements align closely with the broader market. The ETF's 50-day and 200-day simple moving averages are $593.54 and $553.24, respectively, highlighting a steady upward trend. The increased interest from institutional investors like Sterling Investment Advisors, Presper Financial Architects, J.P. Morgan Chase & Company, and Kingstone Capital Partners, Texas LLC underscores the ETF's role as a cornerstone in diversified investment portfolios and reflects confidence in the earnings potential of large-cap U.S. equities amidst current market conditions.
Sterling Investment Advisors Limited has increased its stake in United Health Group Incorporated, NYSE, UNH, by 18.1% during the second quarter, highlighting a growing interest among institutional investors in the healthcare conglomerate. Sterling now holds 680 shares valued at $212,000. This move is part of a broader trend, with several other large investors, including Summit Financial Strategies Inc. and Osseo Capital LLC, also expanding their positions in United Health Group. The company, which operates through segments like United Healthcare and Optum, recently reported a quarterly revenue increase of 12.9% year-over-year, though its earnings per share, EPS, of $4.08 fell short of analysts' expectations of $4.45. Despite the earnings miss, United Health Group remains a key player in the healthcare sector, with a market capitalization of $312.10 billion and a diverse portfolio of services. Analysts maintain a moderate buy rating for the stock, with a consensus price target of $358.95. The company's recent dividend announcement, yielding 2.6%, continues to make it attractive to income-focused investors. However, the firm's stock performance has been mixed, with its share price opening at $344.61, reflecting ongoing market volatility. As the healthcare landscape evolves, United Health Group's strategic positioning across various segments could influence its financial performance and investor sentiment moving forward.
Sterling Investment Advisors Limited has significantly increased its investment in Palantir Technologies Inc., NASDAQ, PLTR, boosting its holdings by 28.5% in the second quarter of 2025. The firm now owns 24,923 shares valued at approximately $3.4 million. This move is part of a broader trend among institutional investors, as several hedge funds and investment firms, including Summit Financial Strategies Inc. and Raleigh Capital Management Inc., have also adjusted their positions in Palantir. The company's stock performance has been strong, with a notable increase in earnings and revenue, reflecting a 48% year-over-year revenue growth in the latest quarter. Palantir's market capitalization now stands at $424.32 billion, with its shares trading at $178.86, close to its 52-week high. The increase in institutional investment comes amidst insider trading activity, where key insiders like Shyam Sankar and Jeffrey Buckley have sold significant portions of their shares. Despite these insider sales, Palantir's stock has maintained a robust performance, driven by its solid financial results and optimistic market sentiment. Analysts remain cautious, with a consensus hold rating and an average price target of $140.22, indicating mixed sentiment about the company's future prospects. Nevertheless, Palantir's strategic positioning in both commercial and government sectors continues to attract investor interest, underscoring its potential for sustained growth in the tech industry.
Eli Lilly and Company, NYSE, LLY, has attracted significant interest from institutional investors, who now own 82.53% of the company's stock. Notable changes include Lifegoal Wealth Advisors slightly reducing its stake, while Duquesne Family Office LLC, Sterling Investment Advisors Limited, Bennett Selby Investments LP, and Tealwood Asset Management Inc. have all substantially increased their holdings, reflecting confidence in the company's prospects. Eli Lilly's stock opened at $725.54, with a robust market capitalization of $686.69 billion. The company reported impressive quarterly earnings, with earnings per share (EPS) of $6.31, surpassing analyst expectations of $5.59, and a 37.6% year-over-year revenue increase to $15.56 billion. This performance is driven by strong sales in diabetes and obesity treatments, including products like Jardiance, Mounjaro, and Trulicity. Eli Lilly's financial health is further underscored by a high return on equity of 92.72% and a net margin of 25.91%. The company has set its FY 2025 EPS guidance between $21.75 and $23, indicating continued growth potential. Analysts have mixed views, with some downgrading their ratings, while the consensus remains a moderate buy, with an average price target of $939.61. Despite recent market volatility as indicated by a beta of 0.47, the company's strategic focus and strong financial performance position it well in the pharmaceutical market. Insider purchases and strategic acquisitions suggest ongoing confidence in Eli Lilly's future, making it a key player to watch in the healthcare sector.